Welcome to Sectors Up Close. I'm Elena Casas. Today we're discussing the impact the US election is having on Treasury yields with Aoifinn Devitt, Chief Global Market Strategist at Moneta. While polls may have Kamala Harris and Donald Trump in a dead heat for the White House, but the bond market tells a different story. US Treasuries are on track for one of their worst months in recent years. The yield on the 10-year has gone over 4.3%. Some of that is down to recent strong economic data, cutting bets of further Fed rate cuts. But many see a potential Trump victory as what's driving yields higher. The presidential candidate has promised a parade of tax cut pledges on everything from tips to car purchases. The Committee for a Responsible Federal Budget, which advocates reducing federal deficits, has estimated that Trump's tax cut proposals would add $7.5 trillion to the federal deficit over 10 years, compared with $3.5 trillion for Harris. He's promised to fund these cuts with tariffs of 10% on all imports and 60% on those from China. So, what does the election mean for the bond market? Let's ask Moneta's Aoifinn Devitt. Aoifinn, hi. How much then do you attribute this recent move in Treasury yields to investors pricing in a Trump presidency?
I'm not actually putting too much weight on the election odds at this time. I think what we have seen, though, is an extraordinary round trip in terms of Treasuries. We're essentially where we were 18 months ago, back when we didn't know about jumbo cuts, when we knew the Fed was data dependent and that we were looking at rates staying higher for longer. That's where we are now. And why is that? As you mentioned, is the economic data. I've seen markets actually being quite insulated from the effects of the election noise. They've been very insulated from geopolitical events, and similarly with the election noise. As you mentioned, it is neck and neck. It is too close to call. And I think whereas we have a vague idea as to what different trades might look like, I don't think markets are factoring that in at the moment.
There are some nerves, though, aren't there, in the bond market? So what is it about Trump's policy that the markets are particularly concerned about? Is it the tax cuts or is it the tariffs?
I would say the tax cuts are what are driving markets higher for the most part, because we know that that will boost the company earnings. They have had very strong earnings so far. We've had over 70% outperforming where earnings expectations were, and that's been very strong. And we know that that will very much play into corporate hands. Tariffs, it's an unknown. We know that actually Biden has put some tariffs in effect around EV manufacturers, for example. So we know that that is already in place. We know that that is a tax on consumers, essentially. It will lead to higher inflation. So I think there is some concern that the Trump policies will lead to higher inflation, which will mean the Fed will not be able to do what it says it's going to do. So I'm not sure it's so much a victory as such, more that we know that we're in a stronger place than we thought we would be from the economic standpoint at this stage.
You mentioned there that the Fed might not do what they said they were going to do. At the moment, of course, the market has priced in at least a 25 basis point cut in November and in December. The first of those meetings is just a few days after the election result. Do you think a Trump victory and the prospect, therefore, of higher inflation could reduce the Fed's room to manoeuvre?
I think the Fed will do exactly what it has always intended to do, which is act according to how it has telegraphed. I think for them to have a knee-jerk reaction to an election result would be highly out of character for this Fed. This is a Fed that is rebuilding the confidence that investors and markets have in it after being late to the table with their inflation call. They are now feeling supremely confident that they have executed upon their soft landing and done so very well, but they will be data dependent, and I think proceeding along this softly approach to cutting rates. So I don't see a political reaction, but they still have plenty of ammunition to have a stronger reaction should they need to, should markets wobble and show more jitters.
Markets are expecting a rise in the US fiscal deficit and therefore bond issuance, regardless of who wins the presidency, but especially in Trump's case. Is there enough appetite among investors to buy all of those bonds?
That's a very interesting question, and that's probably why we're seeing this poor performance for Treasuries at the moment, and concomitantly the strong rise in gold. Because when we see that neither side, and as the statistics you cited earlier, neither side's policies will result in any reduction of the deficit, both are likely to lead to it increasing. It's clear that this is an inevitable conclusion now, and if nobody can be trusted, essentially, to maintain a currency, then where would investors go? But they would go to alternate assets, such as gold. So I think that's driving, in a way, the rise that we've seen in gold to close to an all-time high at the moment.
Let's focus a bit more on those alternate assets like gold. Are you expecting that run-up to continue?
I think it will certainly be maintained. We know that there are many factors that drive the gold price, and one of it is not just the lack of confidence in fiat currency and in government's ability to maintain more stringent controls upon their budget deficit. I think that it's definitely been driven by central bank activity, particularly Chinese central bank activity, a little bit of a move away from the dollar as a reserve currency, although I hear much less mood music around that at the moment, that the dollar will not be perhaps as strong a reserve currency as in the past. That I think, what other currency would possibly be the reserve currency? So that's a factor. So gold, I do see it being maintained. I don't know whether it can run up much higher at the moment.
Aoifinn Devitt of Moneta, thank you so much for that analysis. And that's your look at the US election's impact on government bonds. I'm Elena Casas, and this is Reuters.